Well, I'd be lying to you if I said that valuing internet companies is more of a science than an art. The reality is the first thing we try to do is really get to the kinds of companies that we really are excited about. We see literally thousands of companies a year, and we have to select a few of those to invest in. And the real trick is to determine which of those companies we're really excited about, which one of those companies do we think can actually transform or disrupt industries, can really be fundamentally impactful in a very, not just in a very financial sense, but in a very, societal sense. And I think that when you find those companies, valuation actually becomes relatively easy. And it becomes relatively easy because the fundamental basis of any valuation is all about growth. And growth assumptions are what drives valuation considerations. And you can certainly do DCF models and come out with valuations that range anywhere from 10 million to $1 billion, depending on the kinds of growth assumptions you use, and you can modify those in different ways. Obviously, in an early stage company, we look at one that we're excited about. We look at what kinds of growth assumptions we think are realistic over the near term. We take a risk discount to that, and then we have a discussion and negotiation with the entrepreneur around those valuation considerations. But it is fundamentally, first and foremost, about finding a company that you want, and then you can apply different kinds of metrics to those companies. There's lots of assumptions you can use, all centered around how fast and how rapidly the company can grow, and then you back into a valuation from there. So I think probably the biggest difference in terms of the types of companies and the sort of evolution of investing in startup companies over the last few years is the rise of angel investing, the rise of individuals who have been successful in their own right and want to then invest in other companies that they see as promising, as innovative, as exciting, or simply those folks who see alternative investments, meaning investing in startup companies, as a better route financially to go down than sort of very low-yielding investments that are out there today. So you have the rise of what I would call angels and super angels and seed funds, meaning lots and lots of money that's focused on putting in to companies where they can have a big impact for a relatively small amount of dollars. And the actual cost of building a company, a technology company, has gone down dramatically over the last few years. And that has really led to the ability for angels and seed funds to be able to make smaller investments where you can actually invest $100,000 or a few $100,000 to actually get a company up and running, so that later stage investors or venture capital, institutional venture capital investors can look at those companies and invest accordingly. So lots and lots more seed money available for startup companies. There's an enormous ferment of innovation that's going on with respect to the internet now, and saying that a company is internet focused has become a little bit like saying it's powered, it has electric lighting and water. It's really an omnipresent aspect of any company, any business these days. But in terms of sort of specific thematic areas that we think are very interesting and are very poised for enormous innovation and growth, enterprise is probably one of the largest significant areas that we're particularly focused on now. And certainly the whole consumerization of enterprise is something that has been going on for some time now, for several years, but that process is really accelerating. And the actual decision making of how enterprise decisions are made has tended to go much more decentralized than in the past, where the traditional structure of a CIO making all those decisions, that started to change. You now start to have real constituencies within any given enterprise that try to focus the company on getting certain kinds of enterprise software that they need and want because they're used to it from a consumer perspective. So that's certainly a very significant area of innovation. Other areas of innovation, we think we are tremendous believers in the growth of innovation in the financial services space. It's an absolutely massive space. We talked about consumer credit, again, $3 trillion just in that aspect of financial services alone. This is an industry that has been very traditionally conservative and has not necessarily focused on innovation in the past. And you now have the rise of a lot of extraordinarily interesting and innovative companies in that space that are poised to really disrupt that industry in a lot of different arenas. Other areas that I think are also very interesting, education, ed tech, if you will, I think is a huge arena, huge sector poised for technology disruption and innovation. And healthcare, healthcare IT in particular. Interestingly enough, there are now dedicated accelerators in New York City for those sectors, for ed tech, for healthcare IT, for financial services. So you have accelerators rather than being just a broad-based accelerator like a Y Combinator, for example. You have dedicated vertical accelerators focused on these different areas where it's very clear that massive disruption and innovation will happen in huge industries and huge sectors.